Okay, traders, just going to take you through the futures rules. It is one of the most simplest systems to hedge your options with that I've ever seen. It works, it's profitable, even by itself it's profitable. So what it does is it's more of a momentum system, and that is to just purely hedge the options trades that you have on. So this is the futures indicators you get, the lifetime ownership of this futures indicator, which is with that the cross. If it's a green cross, that means that's an entry to go long, and then if it's a red cross, that means an entry to go short. Now if you're long, your moving stop, which trails up underneath this green line, is the yellow dot. So let's have a bit of a practice and run through a few, and it's very, very simple. You'll get it straight away. So let's move into it also keeps you out of the choppy areas, which is, we're not entering the market until we pierce through this green cross, so we're not in there. We do get put in there and we're stopped straight out, and then there's another trade and we're stopped out there. So that's a long when the candle goes through the green cross, so your stop is down here at the yellow dot, and so on. You go short, put through the red cross, and so our stop's up here, so we stop out. So we get in up here where there's a green cross. So that's our entry. Our entry is this is what happens on the indicator with TradeStation. You get your long entry of 8.14. It is. We just round that up a touch off the long entry there, and then our long stop. Once that triggers, the long stop is this yellow dot. So effectively, we're not in that trade until the market pierces through that green dot, the green cross there. Always take the first green cross. As the market progresses forward, and this one's rallying up while we get triggered in. So then we get a yellow dot which is printed here, and that'll print on every candle, and your stop will slowly creep up as each candle prints. So it's going in your direction. So all you're doing is hedging your options, and you're also have the ability to make some profit on the way. So we're in there at 8.14 because we pierced through the green cross. Now our stop, you automatically put in your platform there at 807 or 806.75 to start. Now as the candles close, well, we're still long, we're still just trailing up with this stop up these yellow dots, and that keeps going until we're stopped out at a yellow dot. So we get stopped out there at that yellow dot, and then we're no longer in the market. And now the indicator will start printing when it's time to go short. Well, when a red cross triggers, you put your order in the platform ready to go at 8.33, and then that stopped triggering. So you take that out of your platform, and now we've got a green cross. So then you're looking for a long at 8.43. Now that triggers, and then you remember your stops there at the yellow dot, and that gets stopped straight out. So in that last trade, we went from 8.14 was our entry, and we finished up there, stopped out at 8.35. So 8.35 take 8.14 is 21 points. Now with the futures as well, that's 21 points on one standard contract. So if you're trading a $25,000 account between 25,000 and 100, well, that'd be one E-mini contract. That's all it'll ever be until you're over 100,000. So you do one E-mini contract, and then once you get to 100,000, you do one large S&P contract. And then if you're at 200,000 in your account, well, that means you're putting two spreads on. So when you put your first spread on, well, you can only put your spread on when you enter into a trade here, into one of the futures trades, and then you put your spread on. So you have to be in the market with a futures trade on your platform before you can put an options trade on. So that's critical. So every 100,000 you can put another spread on. So let's just say you had your one spread on. So we entered the market here at on the 8th of the 4th. Now we put our spread on, and so we're happy with our spreads. We've got our price points, which you can read a document which tells you how to put your options trades on and what they're for. But those trades are in the website as well in today's trades, and you can also view the video on how the spreads are set. But you can't put the spread on until you got your futures trade in there. So we've put our futures trade on. That means we've got $100,000 in the account, or 25. E-mini for 25, one large S&P for 100,000. So that's up there, so that keeps going, and then we're stopped out here. So we've still got one spread in the market, but we're naked in the futures. So now we have an opportunity, because we've got a $200,000 account, to put another spread on. So this staggers your spreads as well, because you're going to have different strike points. So now that we enter into our next trade is a long, so we're long here from the 14th of the 4th. So we've got two spreads on. So this futures trade has to be two large S&P contracts. So every S&P contract pairs with an option spread. So if you've got two spreads on, well, you've got two futures contracts, and so on. That's also mentioned in how to trade the system. It's also in the futures rules. That's just how it works. So then you go again. So we were long, and then we've got stopped out here at the yellow dot. So now we're looking for a short. That doesn't trigger. Now we look for a long up here, green cross. So let's have a look at that. We're in the market on this candle here, and our stop is here. So as the market closes each candle, well, we move our stop up slightly to reduce the risk. All we're doing is hedging our options trade. So bang, we get stopped out. So then we're looking for a short because we've got a red cross. So we go down here and then we're short. So our stop's up here on the yellow dots, and bang, we're stopped out again. That's okay. We're going to get the big move soon. So we go long again up here, and then we get stopped out again. So then we get our move slightly, so we go short again on this red cross, so we're short, and then we're just dragging our stop down as these candles close, and then we get stopped out there. So this just continues on. There's a bit of a choppy stage in this market at the moment. So we enter the market again. We go. Our first one is we go short here. So we're short on those red crosses because the market pierces the red cross. Our stop is the yellow dot above this red and green line. So we get stopped out again. So then we go long, green cross. So we're buying the market there, and then we've got our stops. When the market triggers here, the stops will start printing. They'll start printing. So there's our stop. So that just carries up on the market. Get a short entry there, but our stop's there, and it doesn't get stopped out the yellow dot. So we just carry on, and we keep going up. So this is a bit of a big move. And so there we go, we get stopped out. So that's how you do the futures side of it, and that's the indicator. It's just critical that A, you have one futures contract per one spread, option spread, or B, every 100,000 you have in your account, you add a futures contract if you're adding an option spread. So if you've got a $300,000 account, well, you start with one spread and one contract. You go in your futures trade, you wait. When the futures trade stops out, well, then you add another spread. So then you put two futures contracts on to marry up and pair with the options spreads. So you've got two futures contracts and two option spreads. And you just keep going. You just keep ramping up the option spreads with your futures contracts. And your futures will hedge your options. If the options are going against you, well, your futures have got you covered because you're just making money on the futures. Now, if your futures are chopping in and out and you're losing premium or money on your futures trades, well, you've made money on the options premium. So it doesn't matter if you're going long, short, left or right. It doesn't matter because you've got a paired system where you're hedging each other and it's consistently performing over a long period of time. So thanks for that. That's how to trade the futures side of the strategy. And there's a document that goes with this, so feel free to read that. So thanks for your time.